Hi there, it's Friday the 15th of November 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Hong Kong. Let's get started. As you know, last Friday the OECD released a public consultation document on Pillar 2, which is commonly referred to as the Global Anti-Base Erosion or GLOBE proposal. I should make 2 points up front. The first is that this is a Secretariat document. It's been drafted by the OECD Secretariat and it's not a consensus document which reflects the views of the OECD membership or the Inclusive Framework membership. And the second point is that if you're expecting a Pillar 2 version of the Unified Approach consultation document, which was released in October under Pillar 1, you will be disappointed. The two documents are very different. This Pillar 2 document does not set out a coherent proposal. Instead, it focuses on 3 issues and discusses various ways of dealing with those issues. Based on this document, it appears that the OECD's work on Pillar 2 is significantly less developed than on Pillar 1. You'll remember that Pillar 2 consists of 4 components: an income inclusion rule, a switchover rule, an undertaxed payments rule, and a subject to tax rule. Let me briefly explain each of these. The income inclusion rule would tax the income of a foreign branch or a controlled entity if that income was subject to tax at an effective rate that is below a minimum rate. The switchover rule would permit a residence jurisdiction to switch from an exemption to a credit method, where the profits attributable to a permanent establishment, PE, or derived from immovable property, which is not part of a PE, are subject to an effective rate below the minimum rate. The undertaxed payments rule would operate by way of a denial of a deduction or imposition of source-based taxation, including withholding tax, for a payment to a related party if that payment was not subject to tax at or above a minimum rate. And the subject to tax rule would complement the undertaxed payment rule by subjecting a payment to withholding or other taxes at source and adjusting eligibility for treaty benefits on certain items of income where the payment is not subject to tax at a minimum rate. The consultation document does not deal with 2 key issues with Pillar 2. The setting of the minimum rate and the coordination, in other words, the ordering rule in regard to the 4 components. Both of these items will require major political calls by the 130 plus members of the Inclusive Framework. Instead, the consultation document deals with these 3 issues: tax-based determination, blending, and carve-outs. I'll take you through each of these issues shortly. The consultation document requests public comments by the 2nd of December. There will then be a public consultation meeting on Pillar 2 in Paris on the 9th of December. For a copy of the consultation document, please go to our website or app. Pillar 2 envisages an effective tax rate calculation which uses tax as the numerator and an appropriate tax base as the denominator. This first issue, tax-based determination, is concerned mainly with the denominator. The consultation document suggests that financial accounts be used as the starting point for determining the tax base. The income calculated for accounting purposes would then be subject to agreed adjustments in order to align accounting income with a proper measure of taxable income. I will refer to these possible adjustments shortly. But in regard to financial accounts, a key threshold issue is which financial accounting standards should be used. Should it be the accounting standards used by the parent entity or those used by the subsidiary? The document suggests that the financial accounting standards used by the parent entity should be the relevant accounting standards, provided these are an acceptable set of standards. The document identifies IFRS, US GAAP, and Japanese GAAP as acceptable, although these are not stated as an exhaustive list. The consultation document asks these specific questions in regard to the use of financial accounts. This is the first half of the list. Please hit the pause button to study it. And this is the second half of the list. In regard to adjustments to the financial accounts in order to arrive at a proper measure of taxable income, the document considers both permanent and temporary differences. In regard to permanent differences, the document briefly discusses dividends and differences due to fair value accounting. Here are the specific questions asked by the document in regard to permanent differences. In regard to temporary differences, the document describes over several pages 3 basic approaches. Firstly, the carry forward of excess taxes and tax attributes. Secondly, deferred tax accounting. And thirdly, multi-year averaging. Here are the specific questions asked by the document in regard to temporary differences. This is the first half. And this is the second half. The second key issue which is considered in the consultation document is blending. This is described in this way. Because the GLOBE proposal is based on an effective tax rate test, it must include rules that stipulate the extent to which the taxpayer can mix low tax and high tax income within the same entity or across different entities within the same group. The document discusses 3 alternative approaches to blending. Firstly, a worldwide blending approach, which would require a group to aggregate its total foreign income and total foreign tax. If the foreign tax on the foreign income was below the minimum rate, additional tax would be required. Secondly, a jurisdictional blending approach, which would require a group to aggregate income and tax for each jurisdiction, with additional tax required to be paid in respect of income in those jurisdictions effectively taxed below the minimum rate. And thirdly, an entity blending approach, which would require the calculation of income, tax, and effective tax rate for each foreign entity and each foreign branch. Additional tax would be required for each foreign entity or foreign branch where the effective tax rate was below the minimum rate. The document then considers 6 specific issues in regard to blending. The effect of blending on volatility in effective tax rates caused by temporary differences. Obtaining the required level of financial accounts data. Allocating income between branch and head office, allocating income of a tax-transparent entity, crediting taxes that arise in another jurisdiction, and the treatment of dividends and other distributions. The consultation document asks 15 questions in regard to blending. with most of the questions relating to those 6 specific issues. Here's the first question, which relates to the 3 different approaches to blending. There's one question on volatility in the effective tax rate. There are 2 questions in regard to obtaining financial accounts data. There are 3 questions in regard to allocating income between branch and head office. There are also 3 questions in regard to allocating income of a tax transparent entity. 2 questions on crediting taxes that arise in another jurisdiction. And finally, 3 questions on the treatment of dividends and other distributions. The third issue which is considered in the consultation document is carve-outs, which is stated to include thresholds and exclusions. But there's no substantive discussion of this topic. It's easy to see that the OECD has a long way to go on this issue. Importantly, however, the document asks 6 consultation questions. Here are the first 4 questions, and here are the other 2 questions. The EU-Singapore Free Trade Agreement will enter into force next Thursday, the 21st of November. The OECD has released the latest batch of peer review reports in regard to the International Standard on Transparency and Exchange of Information on Request. This is a second round review of 8 jurisdictions. 7 have been rated as largely compliant, but Panama has been rated as partially compliant. For a copy of the peer review reports, please go to our website or app. In China, the tax authorities have issued guidance in regard to a company's so-called social credit score. Under China's social credit system, government agencies share information on the social performance of companies and individuals. The current guidance provides advice on how to improve a social credit score. For a copy of this guidance, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a double tax treaty case concerning a non-compete fee. The taxpayer is an individual resident in Qatar. The taxpayer sold his shares in an Indian company to a Singapore company. Subsequently, the taxpayer entered into a non-compete agreement with the Singapore company, under which the taxpayer agreed to not carry on in India a business similar to that of the Indian company for a period of 10 years. The taxpayer accepted that he was subject to Indian capital gains tax in respect of the share sale. However, he claimed that he was exempt from Indian tax on the fee under the non-compete agreement by virtue of Article 7, the Business Profits Article of the India-Qatar Treaty. The tax authorities disputed the exemption on the basis that the taxpayer has a PE in India, which was very strange because the facts give no indication of a PE. What is interesting is that the tax authorities and the tribunal seem to accept that Article 7 was the correct provision to apply to the taxpayer, even though the facts don't show that the taxpayer carried on any business at all. And not only that, the treaty contains a provision which corresponds to Article 21.3 of the UN Model Treaty. So I would not have been surprised if the tax authorities had asserted that the other income article allows Indian tax in this case. But they didn't, and that's surprising. For a copy of this case, please go to our website or app. In New Zealand, the tax authorities have released an updated version of their compliance guidance for multinationals. For a copy of the updated guidance, please go to our website or app. In Singapore, the tax authorities have issued updated guidance on the GST treatment of web hosting services and server co-location services. For a copy of the updated guidance, please go to our website or app. In Denmark, the tax board has decided another case concerning the PE definition under the Danish domestic tax law, which is very similar to the definition in the OECD Model Treaty. You'll remember that I covered an earlier case on the same topic in ITB last month. Here is the relevant structure. Exco is a company which is resident in another EU member state. Exco has an employee who is resident in Denmark. Exco requires the employee to work from his private residence. In other words, no office facilities are provided to the employee. The employee's role has two aspects. The first is to build a network of independent dealers in Denmark who will purchase and resell Exco's goods. And the second is to provide ongoing marketing support to the independent dealers within the network. Importantly, the employee does not conclude any contracts with the independent dealers. The board held that the employee's presence in Denmark did not cause Exco to have a PE in Denmark under the Danish domestic tax law. As I said, that definition is very similar to Article 5 of the OECD Model Treaty. The board held that the employee's private residence was a fixed place of business of Exco. However, the board also held that the employee's activities fell within the preparatory or auxiliary character exception corresponding to Article 5.4 of the OECD Model Treaty, a conclusion which I find surprising. For a copy of this case, please go to our website or app. The European Court of Justice has decided a free movement of capital case in regard to dividends paid to a Canadian pension fund. The Canadian pension fund owns shareholdings, each less than 1%, in a number of German companies. The German companies paid dividends to the Canadian pension fund and deducted 15% dividend withholding tax in accordance with the Canada-Germany Treaty. That withholding tax is a final German tax and it is imposed on the gross dividends. The Canadian pension fund argued that the imposition of the dividend withholding tax breached the free movement of capital, which is required by Article 63 of the Treaty on the Functioning of the European Union. For that purpose, it argued that its position should be compared with a hypothetical German pension fund which holds portfolio-level shareholdings in German companies. In two key respects, the German tax treatment of a German pension fund is materially different from the German tax treatment of the Canadian pension fund. Firstly, although withholding tax applies to the gross dividends paid by the German companies to the German pension fund, that withholding tax is not a final tax. It can be credited against the German pension fund's final income tax liability. And secondly, the German pension fund is able to claim deductions for technical reserves. Taken together, these two aspects cause a German pension fund to be exempt or practically exempt from tax. The court held that it is appropriate to compare the Canadian pension fund with the hypothetical German pension fund. And it also held that based on those two material differences, the dividend withholding tax imposed on the Canadian pension fund does breach the free movement of capital requirement. For a copy of this case, please go to our website or app. At the ECOFIN meeting last week, political agreement was reached on two VAT initiatives. Firstly, there was agreement on new rules for the exchange between member states of VAT payment data. Importantly, the new rules will require payment service providers to keep records of cross-border payments related to e-commerce and to make that data available to national tax authorities. The new rules will be effective the 1st of January 2024. For a copy of ECOFIN's press release on this topic, including the text of the agreement, please go to our website or app. The second initiative on which there was agreement concerns simplification of the VAT rules applicable to small businesses. For a copy of ECOFIN's press release on this topic, including the text of the agreement, please go to our website or app. The ECOFIN meeting also agreed to make two changes to the EU's lists of non-cooperative jurisdictions. Firstly, Belize has been moved from the black list to the grey list. And secondly, North Macedonia has been removed from the grey list. For a copy of ECOFIN's press release on this matter, please go to our website or app. The EU Council has authorised the Czech Republic to apply a generalised reverse charge mechanism for VAT in the period from the 1st of January 2020 to the 30th of June 2022. For a copy of the Council implementing decision on this matter, please go to our website or app. In Malta, the tax authorities have published updated guidance on the notional interest deduction. For a copy of the updated guidance, please go to our website or app. In Nigeria, the Tax Appeal Tribunal has decided another case in regard to the so-called excess dividends tax under Section 19 of the Companies Income Tax Act. You'll remember that I covered another case on Section 19 in July. This recent case concerns a situation where a Nigerian company derived income which is exempt from Nigerian income tax. It then paid a dividend from that income, and because the amount of the dividend exceeded its taxable profits, it was assessed for excess dividends tax. The tribunal agreed with the tax authorities, a decision which is in line with recent decisions on Section 19. As with earlier cases, commentators have criticised this decision. It's also important to note that the Finance Bill 2019, which I will discuss shortly, proposes significant changes to Section 19, which should overcome the effect of these recent decisions. Also in Nigeria, the Finance Bill 2019, which I just mentioned, is currently before Parliament. There are 4 items worth noting. In regard to corporate income tax, the bill will introduce a significant economic presence rule to determine the taxation of non-resident companies in 2 situations. Firstly, non-resident companies operating in the digital services and e-commerce sectors. And secondly, non-resident companies which furnish technical, management, consultancy or professional services outside Nigeria. The bill gives the minister the power to determine what constitutes a significant economic presence in Nigeria. Secondly, also in regard to corporate income tax, an interest deduction limitation rule based on BEPS Action 4 and set at 30% of EBITDA will be introduced. Thirdly, as already mentioned, the bill proposes significant amendments to Section 19, the so-called excess dividends tax, which should remedy the defects exposed in recent cases. And finally, as previously announced, the bill will increase the standard rate of VAT from 5% to 7.5%. For a copy of the bill, please go to our website or app. In Chile, the government and major opposition parties have reached an agreement for tax changes to raise revenue in response to anti-government demonstrations and strikes over the last 3 weeks. The proposed changes will be incorporated in a bill which will be sent to Congress in the next few days. There are 5 key tax changes, some impacting individuals and some impacting companies. Firstly, a new top marginal personal income tax bracket of 40% will be created. Secondly, there will be stricter conditions for the preferential tax treatment of private investment funds and publicly traded investment funds. Thirdly, the provision which allows tax losses to be used to obtain a cash refund of the corporate tax imputation credit will be repealed progressively over 4 years. However, tax losses will still be deductible against business income, and the imputation credit will still be available for use against shareholder taxes payable on dividends. Fourthly, the current partially integrated corporate tax system will be continued for large companies. Currently, imputation credits are limited to 65% of the corporate income tax paid. The plan was to increase that to 100%, and that will still occur for small and medium-sized companies. But for large companies, 65% integration will remain. For this purpose, a large company means a company with annual revenue exceeding about $2.8 million US. And the existing provision which allows the immediate expensing of 50% of the value of new investments in capital assets will be extended to the 31st of December 2021. In the US, the Court of Appeals for the Ninth Circuit has denied the taxpayer's request for an en banc rehearing in the Altera case. You'll remember that a 3-judge panel, by a 2-to-1 majority, decided that the 2003 cost-sharing regulations concerning stock compensation are valid. Despite a large number of supporting briefs, the Ninth Circuit has now denied Altera's request for an en banc rehearing by 11 judges. The Ninth Circuit's decision on the en banc rehearing is stated in summary fashion without reasons, but it's followed by a vigorous dissent by Judge M. Smith. For a copy of the decision, please go to our website or app. And now for this week's treaty developments. We've had 1 treaty signed, 1 protocol signed, and 1 protocol enter into force. I have 2 articles for you this week. The first article is called Transfer Pricing Aspects of Transactions with Marketing Intangibles in a Post-Beps World. It's written by Alyssa Feddy and it's published in the International Transfer Pricing Journal. This article provides a good overview of the transfer pricing treatment of marketing intangibles. In particular, it describes several court decisions and administrative guidance in the US and elsewhere on this topic. And the second article is called Bulgarian Data Hack Provides a Timely Warning of Data Breaches to Come. It's written by Philip Baker and it's published in the Intertax Journal. This article relates to the hacking of the IT system of the Bulgarian tax authorities in June this year, in which the personal data of up to 5 million individuals in a country with a population of 7 million was stolen. The author writes this: "It is difficult in the light of the Bulgarian data theft not to see the OECD's common reporting standard as a disaster simply waiting to happen." Well, that's the way it is this Friday, the 15th of November, 2019. I'm Steve Towers in Hong Kong. Have a great weekend.